You ever see a pro investor making all the right moves and just wish you could, well, copy their homework? That's the incredibly appealing promise of copy trading, right? The idea that you can mirror the success of seasoned traders and just skip all the hard work. It's a powerful concept, no doubt.
But here's the real question. Can you actually trade like a professional with just one click? Is it really that simple? That's what we're going to dig into today.
All right, so first things first, what exactly is copy trading? Simply put, it's a service where you link up a piece of your portfolio to another trader's account. And from that moment on, every single trade they make, opening a position, closing it out, it all gets automatically mirrored in your account, but, scale to your investment. You're basically letting them take the wheel.
So here's our roadmap. We're going to start with how this whole thing actually works. Then we'll pull back the curtain on the real costs and, the risks. After that, we'll get into the most important part. How do you even pick someone to follow? And finally, we'll take a look at where this is all headed.
Okay, let's get into the nitty-gritty. Now, copy trading didn't just pop up out of nowhere. It actually evolved from these older, kind of secretive systems into the more social, transparent platforms we see today. The whole story really starts back in the early 2000s with something called mirror trading. By 2005, you had the first automated platforms hitting the scene. But the real game changer? That came in the 2010s, when social trading platforms burst onto the scene. They really pulled back the curtain and added this layer of community and transparency that just wasn't there before.
And it's really important to understand the difference here. Mirror trading was like following a secret recipe. You were copying an entire strategy, usually without a clue about the logic behind it. It was a total black box. Copy trading, though, is about following a person. It's way more transparent. You can see their stats, their track record, and you have so much more control to just stop or make adjustments whenever you want.
So how does it work moment to moment? Well, it's actually pretty straightforward. You link your account, you decide how much money you want to allocate to a certain trader, and that's it. When they make a trade, it sends out a signal. The platform grabs that signal and instantly copies the trade in your account. And this is the key. It's all proportional. If they risk 1% of their capital on a trade, the system risks 1% of your allocated funds.
Now, it all sounds amazing, I know, but it's definitely not a free lunch. It's time for a reality check. Let's talk about the hidden costs and the very, very real risks of automated trading.
So when your trades make a profit, that money isn't all yours. Think of your gross profit like a pizza. Before you get your slice, a few other pieces have to come out first. There's performance fees for the trader, the platform's trading fees, and then a few sneaky hidden costs we're about to get into. What's left over? That's your net profit.
The biggest slice that comes out is usually the performance fee. This is the cut you're paying directly to the trader you're copying for their good performance. It can be anywhere from 5% all the way up to 30% of your profits. And it just gets deducted automatically.
And then you have the costs that aren't so obvious. Things like slippage and latency just mean your trade might go through a split second later and maybe at a slightly worse price. You've got spreads, which is how a lot of those commission-free platforms actually make their money. And if you're copying a trader who uses leverage, that's borrowed money, well, those overnight fees can slowly but surely eat away at your returns.
Okay, let's put some real numbers to this. Imagine your copied trades make $1,000 in gross profit. Nice. But hold on, a 10% performance fee takes $100 right off the top. Then you add in a few bucks for trading and funding fees, and suddenly your actual take-home profit is closer to $892. That's more than 10% of your winnings gone before you even touch it.
But honestly, fees aren't even the biggest risk here. The most critical principle in all of investing is this one right here. Past performance is not an indicator of future results. And this is where the really serious risks of copy trading start to show up.
See, here's the thing. When you copy someone, you're not just copying their brilliant wins, you're also copying their mistakes, their emotional trades, their bad days, everything. A lot of the top-ranked traders got there by using a ton of leverage, which amps up your risk of getting totally wiped out. Then there's stuff like liquidity risk, where you could get stuck in a trade, or just plain old systematic risk, where a big market crash takes everybody down with it.
And please do not underestimate the danger of that leverage. Financial regulators consistently report that over 70%, 70, of retail accounts that use leverage end up losing money. It's a tool that magnifies your losses just as powerfully as it magnifies your gains.
And the risks don't just come from the market. You've got risks from the platforms themselves and even from your own brain. Unregulated platforms can be a minefield. Technical glitches can cost you real money. And then there's you. The temptation to panic and manually override a trade at the worst possible moment is very real. And finally, the platforms themselves can create this high-tech herd mentality, pushing everyone to copy the same handful of traders, which concentrates a ton of risk in one place.
So, with all these risks swirling around, how can you possibly make a smarter choice? Well, this gets to the most important skill in copy trading. It's not really about trading yourself, it's about becoming a manager of traders. It's about looking way beyond those flashy numbers at the top of the leaderboard.
So don't just get dazzled by the huge return on investment number, look for consistency over a long time. Check their maximum drawdown. That's a fancy term for the biggest loss they've ever had from a peak. It tells you a lot about their real risk management. A 95% win rate means nothing if the other 5% of trades are so catastrophic they wipe out all the wins. And finally, you got to understand their style. Is it a fit for you?
And maybe the most important strategy of all is the oldest one in the book, diversification. Don't put all your eggs in one basket. Relying on just one person is a massive risk. If you copy a few different traders with totally different strategies, you can spread that risk out and hopefully get much more stable performance over time.
Now, because of all these risks we've just talked about, the entire copy trading industry is coming to a major turning point, and that is the rise of regulation.
The big financial watchdogs all over the world, we're talking ESMA in Europe, the FCA in the UK, ESIC in Australia, they are all taking a much closer look at these platforms. They're stepping up their game to protect consumers.
And what are they pushing for? Well, they want platforms to make sure copy trading is actually a suitable product for a client. They're demanding better vetting of the traders you can copy, much clearer transparency on all the fees and risks, and rules to make sure these high-risk products aren't just being sold to people who don't understand what they're getting into.
Which really brings us to the final big question here. Is copy trading a smart tool for diversifying your investments, or is it just a high-tech platform for a dangerous herd mentality? You know, the truth is, it's probably both. It's a tool, not a magic solution. And whether it works or not depends almost entirely on the research and the discipline of the person using it.
And of course, the important reminder. This explainer is for informational purposes only. This is not financial advice.